All right, so this is Lemonade's Q3 2024 earnings report. First of all, I'm going to go through their letter, give you some of my highlights and my analysis on it, and then also dive into my model and show you a number of graphs that go deeper than just the letter. So let's dive in. So first of all, 889 million IFP. In my own modeling, I was higher. I was like 910, so definitely off. I even said that I thought I was probably too high in that modeling. But my customer account was very, very close. I was just slightly over what they are predicted here, about 2.3 million customers. Premium per customer, 384. And what's interesting, 384 for premium per customer. It's actually down $3 from the previous quarter. So a slight change in premium per customer. I'm guessing that's partly due to the fact that they're non-renewing a lot of home customers in the quarter. So you're ditching probably a high premium per customer, customer base there, ditching, canceling, non-renewing those customers. That's hurting your premium per customer as you continue to grow. But flat there, though I'm sure over time the premium per customer will continue to rise to much higher numbers than even this is at. Yeah, 2.3 million customers, 73% gross loss ratio. I think a surprise for some people. I was predicting around 70%. Also saying this is really tough to predict, but some people I think, and maybe the market in general is thinking, hey, there was some bad hurricane season in Q3. That maybe catastrophic losses are going to be worse, that this is going to be more like, maybe 80% or high 70s. So 73, really, really solid results there. This is really, really great cash flow. A net cash flow positive quarter, so they have 48 million. Now, granted, they're also taking on more debt, but overall, they're just illustrating that point that the overall cash cushion is the same or increasing just because of the synthetic agent program. But then they also note cash flow from operations was positive in the third quarter. Did not expect that at all, of 16 million. And then actually it was a great tweet here by Matt Smith. He said, I did a quick analysis and found that Lemonade synthetic agents cash flow, so financing, what they're bringing in, less repayments, what they're paying out right now, was 20.5 million in Q3 versus a total net cash flow of 48. So even with the synthetic agents, sort of his quick and dirty math, I haven't checked that at all or thought about it, but I definitely trust Matt and his math, is they're still in a cash flow positive scenario, even if you forgot about the synthetic agent program right now. So as they mentioned here, IFP is growing 24% year over year, and I do kind of expect it'll be very interesting when Q4 results come out and we get the guidance for 2025. But I do think, into next year, in the next couple years, we're going to see this. I think we're going to see growth go back into the 30+% year over year range. Loss ratio keeps improving. Gross profit increased 71% year over year. Operating expenses are much higher. They're up 26 million because they spent 27 million more on growth spend than a year ago. So if you exclude the growth spend, basically they're more or less unchanging or level the rest of their operating expenses. And adjusted EBITDA was minus 49. That was expected. It's worse than the year prior. That's because they're spending 3 times the amount on growth spend. So you're spending all this investment now, you get these customers, and then, these customers stay there and they continue to grow with you over time. And another little hint here, again, of how I think they're going to grow more in the 30% kind of top line IFP range in the next few years. They say, we are well positioned to continue the trends of accelerating growth and improving efficiencies in the quarters and years to follow. And they also say, hey, come to Investor Day, November 19th. That's next month in New York. So maybe even next month, I'm expecting Investor Day will get a lot of hints about the vision for the car product, how car is going to be expanded in the next couple of years. But maybe they'll even give us some kind of preview into the guidance for 2025, 2026. You would think we'll probably get some hints or nuggets there at that Investor Day. Then this whole paragraph here, they talk about how, hey, we believe our model is working. We're diversifying our portfolio. We're getting into more products like pet, car, Europe expansion that are less catastrophic exposed. We have less catastrophic sort of exposure overall in the book of business. And we believe this overall strategy is working. They're non-renewing customers. They feel like that their AI models are saying these are not these are not underwritten correctly, and they're too risky or too expensive of a customer, too much risk for how much premium they bring in. So they're basically saying all those things working together. It's working because our catastrophic exposed business is going down. And they're saying if they hadn't pursued this diversification, CAT impact to our gross loss ratio in Q3 would have been roughly 40% greater. So way, way worse if they hadn't had this kind of diversification that they're working towards. And it's funny too, I think a paragraph like this, like Lemonade is a company that takes a lot of criticism. And a lot of kind of like the people that do, 5 minutes of analysis on the company, they say, they're supposedly this AI company, then why is their loss ratios been too high? That's been the narrative for the last, year or so as you look back, at their gross loss ratio. We're going back was 83, 94, 87, 89. That was the whole narrative was, oh man, this isn't an AI company. They can't deliver loss ratios. This doesn't make any sense. That was kind of the like 1 inch deep analysis that's all over the place. The people don't even read these letters, just throw out there. But in my mind, all of that was pretty poor analysis, because if you think just because by its nature, insurance is such a slow feedback loop. They talk about this feedback loop. They have a tight feedback loop between their continuously improving LTV AI models and customer acquisition engine. That's true because all of that's in-house. But then they talk about they're having to see rate increases with regulatory bodies. That's a very slow process to get all those rate increases approved and then also wait until your customers are back at a point where they're renewing and then renewing your products with you. So that sort of, it's not like you just, we want to change this price and you flip a switch and charge all your customers for the, starting next month, we'll charge you all more for your policy. It's a slow process to make that happen. And so naturally, because of that, it doesn't matter how good you are at the AI underwriting risk assessment, it's going to be a slow process to sort of see that change. And then they talk about operating leverage, how they've last 2 years, IFP's grown 21% and is 3 times the compound annual growth rate of operating expenses at 6%. And then if you exclude growth, which is mostly funded by their synthetic agents, operating expenses have been roughly unchanged, basically flat, which shows this graph right here, operating expenses including growth. I've seen some people criticizing this on Twitter or X as well, or on the internet. It's like, you really do not understand. Some people are pretty dense. I'm sorry, but some people are just slow to understand the point of what someone's trying to make. Or their mind is made up that they're negative on something, so they just find whatever negative thing they can. But the point of them sharing a graph like this is, of course, to show us, hey, excluding growth, which all the other expenses, which are your true fixed expenses, operating expenses, those are flat, even though IFP has gone from 600 to nearly 900. So, and we think that trend, that's what management says, and looking at their overall strategy of how they're making systems more and more efficient and more automated, you think this trend will just keep going. And this will stay, maybe 80, maybe even drop, and this will keep going higher. So the reason they share this is because these are all your fixed expenses versus your growth expenditure. The more you want to grow your IFP, the more you're going to spend in growth spend to push that number along. So I don't know, maybe that's super obvious to everyone watching my video, but I've seen people question or not understand that on the internet, or people that are bearish on Lemonade point that out and say, hey, this is a bogus graph because you got to include growth spend. It's like, well, you really don't even, I don't even know I don't know how you would think that, but again, some people just don't seem to get it. So. And then this shows a nice graph of IFP per head count going from 340 to 731. And then this gives a nice little paragraph about what's coming up. Again, they reiterate, continue to acquire profitable business, acceleration unlocked via synthetic agents program, and increasingly leaning into cars. I mean, that's the key sentence. I think growth, top line growth is going to accelerate. I think we're going to go back into the 30-some% range, and I think car is going to grow significantly over the next few years. And they say, powered by technology's unique ability to drive operating efficiency, will continue to deliver stability in operating expenses. So probably this gray line is just going to stay pretty much flat in like the mid-80s, and this pink line is just going to keep rising. And maybe even hit a bit of an inflection point as they start cross-selling people into car. That would be my prediction. Not investment advice, but that's how I think about the future, and it is an exciting future for Lemonade. Cash and investments, they have about $979 million as of the end of Q3, so that continues to climb. If we look at guidance for Q4, one interesting number is adjusted EBITDA loss for Q4 is minus 29 to minus 25, so significantly better than the minus 49 from this quarter. If we look at last year, that pattern happened again. Was Q3 was minus 40, and then Q4 was minus 29 as they spend less. Big difference is because they're spending less on growth spend in Q4 versus Q3 is they're always there. One of their biggest quarters that they're pushing the growth spend. Then at the bottom, very, very bottom of the earnings report, we have this insurance supplement page, and they have all kinds of breakdown of loss ratios and IFP per product, premium per customer product. It's like the holy grail of what we've been hoping for and looking for as Lemonade investors, of people really being nerdy about this and digging into the details carefully. This is going to be really, really valuable for how we model things out, and has some just at first glance and looking through this, some interesting things to point out. So loss adjustment expense is at 9% for the last few quarters. It was 11% a year ago. They highlighted this, I think it was 1 or 2 quarters ago. And loss adjustment expense is just the portion of your loss ratio that is used to administrate and pay out claims. So if somebody makes a claim, maybe you have people that are involved that are checking on the claim to make sure it's valid, to understand if it's correct or not, to negotiate or check into things with the customer, how much should be paid, et cetera, et cetera. All that kind of administrative overhead falls into that, that 9%. 9%, as they pointed out in a previous quarter, is really, really good for an insurance company, especially an insurance company that's heavily into, IFP breakdown, $889 million, $254 pet, and a good chunk of this home and multi-peril, which is home, condo, and renters, is going to be your renter's insurance. So these kind of unloved, less loved insurance policies that have not a lot of premium relative to they make a claim and higher frequency of claims. They have to be very, very efficient to keep this to keep this number still at 9%. And you kind of wonder, you think this will probably, I think Lemonade, depending on how their product mix, but they might be able to even get this lower over time. So depending on how much they can automate things and depending on their product mix, those kind of 2 factors. But it's a huge advantage because, say, maybe other insurers are 12%, 13%, whatever it is, and maybe they can get to like 6% and somebody else is 12%. Well, that's a 6% difference in your loss ratio that just is pure value creation from their technology. So really interesting to watch that. I hope this chart, this whole table, is something they continue to release over time. Would be really, really awesome. Unfortunately, they give this homeowners multi-peril, which includes home, condo, and renters. So it's a mix of like probably their best product, renters, and probably their worst product, homeowners. I might, for another video, take some of the previous data we had on renters, and then with this, use the previous data, breadcrumbs we have to pull out what was the true loss ratio for home, what is a true loss ratio for renters, because I assume renters might be like 50%, might even be less than 50%. And as is probably a function of home is improving, but renters is also improving the loss ratio, but then they're canceling or getting rid of more homeowners while bringing on more profitable renters. And if you look here, as an IFP breakdown, homeowners multi-peril was 420 a year ago, now it's 488. So not a ton of growth in that line, but they've probably been canceling a lot of the home owner's function of that. So it would have been nice if they broke that out. I don't think it's it's not a secret to anyone that homeowners has not been great, and even for the industry as a whole has not been great. So it would have been nice to see that, but we could do some of the work and break that out pretty easily. Other interesting thing, pet has been growing nicely. It was 166 a year ago, now 254 million of the portfolio. And also, this surprised me, pet premium per customer. So for pet customers, their pet policies, $622 average a year ago to $712 now. So man, that is higher than I thought people were paying or realized people were paying for a pet policy, and still carrying within that a gross loss ratio, of sort of high 60s. One quarter was 63%, for whatever reason better, sort of low 70%. So it's still a very profitable business within that line. And my guess is some of these people, maybe their pet policy just costs. They have a dog and the dog's more expensive and it costs that however much per year. But also there's probably people that have multiple pets, 2 dogs, 2 cats. I don't know the statistics on this, but I'm going to guess if you have a pet, you're probably more likely to even have another pet. And if you have a pet you care enough about them to pay pet insurance for, probably even more likely you are to even have 2 pets and pay pet insurance for both of them. So that I'm sure there's customers that have the cheapest basic, $300 a year of premium for their cat, and then people that have 2 dogs and are on the high side of this, and they're paying $1,200 a year in premium, and the 2 are balancing out to an average of $700. So, but really, really, obviously, pet is a fantastic product. We've talked about this on the channel before. It's growing. It hardly has any penetration in the U.S. People are having less kids overall on average, but pet ownership is rising. People are going to care more about those pets. They're going to buy more pet insurance. So pet insurance on its own, just from Lemonade's perspective, is super bullish that they can have a loss adjustment expense on the whole book of business, 9%, probably can make that even better over time with more technology, and then keep growing this overall pet book of business. It's only 254 million now, and you think, oh, maybe that alone could be a few $1 billion, the pet insurance. Okay, now let's talk about car. Car. 3 very interesting lines on car. Loss ratio for car was 104% a year ago. Now we're in the positives. 92 was 99, 99, 95, 92. I'm sure as rates have been coming online, that's probably the biggest factor which increasing this profitability. And my guess is this is just going to trend down, eventually into the 70% range. Car IFP, on the other hand, hardly changed. 114 million. Now we're at 117 million. Basically had no change in car over the last year in terms of, its amount of dollars of premium on the book of business. But Daniel said this, they said this, in this letter and previous letters, in the video interview he did with me earlier this year. He says, hey, at the end of 2020, end of this year, start of 2025 onwards, car is really going to accelerate in growth. So be interesting to see, maybe does this double? Does this triple over the next year or 2 years? Something like that. I would not be surprised. And a lot of those dollars are probably going to be cross-sold to the existing, 2.3 million customers and growing. So very, very interesting to see. And then a premium per customer, that's obviously very significant. If you can get a customer that's, their average right now is $384. They're bringing a customer and they're a renter or they're a pet or whatever they are, and then you can sell them a car product, and the premium per customer car went from $13 to $17.50. You can see that it's really, really significant product to sell people to. So this is the whole thesis of Lemonade that we're going to start to see play out in the next quarters and next year, 2 years, is this cross-selling of this 2.3 million customers and growing into products, especially products like car. And at the same time, car becomes more and more profitable as the underwriting becomes more sophisticated, and they can select the people they want or don't want with a little more care. And also as rate increases keep coming online, then you're going to also naturally see this 92% drop, but your premium per customer will probably continuing to rise under the car heading instead of, you can see probably the reason it's climbing here from 13.15, 17.51 is due mostly because of rate increases that are coming online. You can also see, it's kind of interesting to see Europe, all products for Europe. This is probably how Lemonade started in the US, was very low premium per customer. You see it's only in the $100, $129 range. But that over time, as they just offer more products, they offer more coverage within those products, then you're going to see this premium per customer slowly rise, just like it has been in the US. But they're expanding right now. It's just so smart, their strategy. They're expanding, taking that market share, taking that mind share, getting those customers now as they're young, and then they'll slowly grow with them over time. Okay, so now let's dive into my Lemonade model. This model is available on my Patreon if you want to support the channel. That is awesome. Really appreciate that, everyone who supports me. But I'm going to flip through a number of graphs here. I have them all tabbed up here and kind of see roughly how many we're going to get through here, of different things that go a little bit deeper than even what Lemonade just tells us in their letters, just from my own modeling. So first off, we'll look at what I'm calculating as on a quarterly basis, just using each quarter's numbers, which can vary quite a bit, but using those numbers, what the LTV to CAC is. Q3 was 3.6, so very healthy number. 3.1 was before that. 3.8 was higher. 4.7. Some of these quarters, if they were higher, and they're higher in part just because they were spending a lot less on the customer acquisition side. So for Q3, they had so much to spend that much on the customer acquisition side, like a record amount of growth spend, and still have an LTV to CAC of 3.6, really, really strong and encouraging. And if you're wondering at all, like, okay, how do we even get a number of like 3.6 for LTV to CAC? Here's the variables, right? It's a summation series from now into the future, indefinitely in the future. Of course, at some point in time, it doesn't matter because customers churn away, but it's your premium per customer times by 1 minus your gross loss ratio. So how much is left over times by your annual dollar retention to the power of n. So this applies the further out into the future you go, this churns away your values. I've done some videos on this, and then I've realized some people, I don't know if they really understand the math, but I could try and do another video. If you thought that was interesting, let me know in the comments down below, and I could try and do another video that explains that, tries to explain this a little more, make sense of this a little more clearly for you. But if you just put in the numbers from this quarter, say a premium per customer, say a cohort of customers comes in at $384 per customer, and they have a 73% gross loss ratio, and this assumes that's the same number over the whole life, even though we know over time that number improves over time, but just say it stays the same over time. And then annual dollar retention is 87%, exactly what we had. And I'm saying 4% for time value of money. Maybe you could argue that should be higher, but whatever. That's what I put in least for these graphs that you're seeing here. So 4%. And a customer acquisition cost for the quarter, 175.8. Your LTV is 634, and that's just saying, hey, that's this equation right here for LTV. That's just saying the present value of all the future profits you're going to make from your customers is $634. And that includes your annual dollar retention, includes the amount of customers that are churning away, plus the customers that are their premium per customer is rising over time. So it factors both of those things in. It's saying, hey, they're worth 634, but you're paying 175 right now. That's all present value. Your LTV to CAC is 3.6. But you could say, hey, maybe in the future, we're going to start getting customers that are like $500 per customer. Maybe the gross loss ratio is actually going to go down to 70%. Maybe annual dollar retention stays there. Maybe keep the time value at 4, and maybe CAC goes up to, these are more expensive customers. It's more competitive. They start rising to 200. You could easily get to LTV of 900 plus and like an LTV to CAC ratio of 4.6. Just for illustrative purposes, we've played around with these in other videos, but really strong LTV to CAC ratios that they're getting. If we look at their net customer growth, so this is overall what the customer growth change was. Q3 was 146,000 customers. Not as strong as maybe other customers where we've seen like, other quarters like Q3 of 2021, 157,000. But still a, really strong, one of the strongest quarters for customer growth. This one, Q3, 196,000 was when the Metro Mile acquisition occurred. I just put this in here. This is my projected premium per customer. Of course, there's lots that could change out in the future, but my projected premium per customer, we've been riding this line over time. You could look at premium per customer historical. Up till now, you can see there was a slight dip from Q2 to Q3, which we talked about earlier. But I'm showing this just to illustrate to you, hey, over time, right now they're only $380 some per customer, but over the next few years, you're going to see a bit of an inflection point where the slope is here, and then it starts to change and increase at a higher rate as they get more and more car customers, and probably eventually, and also home customers, as they can write that profitably under their book of business. And then instead of only $300-400 per customer, they're going to have $1,500 per customer, or higher than that as they grow with these customers and they have these more expensive offerings really rolled out. Next, we want to look at adjusted EBITDA on a trailing 12-month basis. So this goes back to when they talked about peak losses. I think it was Q3 of 2022, and then peak losses have been behind us. We've continued to see improvement, and we've seen a bit of a dip here in the last few quarters, even if you look at adjusted EBITDA not on trailing 12 months. Here we go. This one right here, you can see it got way better, and now it's going to got worse. Now, actually, Q4 will again drop probably back into the mid-20 range. This was 29. Q4 will probably be one of the best ever. Will be sort of low 20 minus 20 range, and then over time, all the investment they're making in growth is going to pay them back, and then you'll continue to see this improvement as they scale towards profitability. And that's I've shown out here roughly what I mean, some of these years into the future. This is showing 2024, 25, 26, 27. I have to model out a little more carefully or look at the numbers again, but I'm roughly showing, hey, the trend line is somewhere in 2025, end of 2025, 2026, somewhere in their range. You'll start to get to break even adjusted EBITDA as a function of gross earned premium, as a percentage of gross earned premium. This shows customer churn from 12 months prior as a percentage. I have a slight improvement. It's like 16.3% over 16.5% from the quarter before, but slight improvement there. And I got a message on Twitter. It was made a good point that, hey, this actually, as they've been non-renewing more customers likely in Q3, this would have a bit of a negative effect on this. So maybe we'll see some bit of further gains over time in this value. And you think over time, as you have certain customers that really very stable customers that stick with Lemonade longer and longer term, you might see some more improvement. Maybe this trends down to like 12%, 10%. Will be interesting to see in the long span, long term. But then also, this is kind of interesting, shows churn from 12 months prior as millions of customers. So showing that over a 12-month span, there's like 300-some thousand customers that are churning away. We've seen this drop as churn has really dropped and improved as a percentage, but you're going to see it kind of stay level or slightly increase just as the overall book of business increases. Now, on this marketing efficiency tab, I have a number of graphs here, but I want to focus on this one specifically, which is how much they're spending in customer acquisition versus the amount of IFP that is being acquired. So you can see here, not great, actually, kind of troubling that this was really high, 4.7, and now we've seen it come down to even 1.98. But the reason why this is, I think we saw such great numbers over here, and now we've seen such a drop in numbers, is just because the amount of customer acquisition spend, growth spend, if you look here, this blue line, the growth spend has skyrocketed or really taken off. And actually, if I overlay this sales and marketing or growth spend over top of this graph, you can see that right here. That's exactly what I'm trying to say. As they spend less on growth spend, this equation of the amount of premium you're gaining per amount of growth spend you're spending is higher, which makes sense because, I mean, really, if you spent nothing, this bar would approach infinity because you'd spend $0, but you get some certain amount of premium that would still be acquired just from the customer book of business, cross-selling and upselling to itself. So, but you got to see the inverse. As you spend way more on growth spend, well, then your ratio here decreases. So next quarter, I'm expecting that they're going to spend growth spend maybe $24 million is what I have right now. And if I find where I was there, $24 million next quarter, you expect that the your overall ratio here probably follow this blue line somewhere again, maybe more like the 2.7 range. And then and then also as they expand car and have more product offerings, I would expect this graph kind of in relationship to change a little bit more and become more positive, where you're getting more premium for the amount of CAC spend you're spending overall, just because the existing book of business can cross-sell, upsell the car, and you can also bring in the sort of lowest hanging fruit car customers. And then flipping over to another graph I have further down on this marketing efficiency page, you can see this was up to Q2 2024. It's a graph of how much they're spending on or gross spend versus how much customer acquisition costs, the average customer acquisition cost that they're spending. So as you can see, as you spend more gross spend in a quarter, you're also, you're costing you more to get each customer. And these three pink dots here were all Q3 numbers that were highlighted. And then I had it here, I don't have them highlighted, but I have them shown here up to Q3 2024, which now has that data point of this Q3 right there, which is way further to the right. They've spent way more on gross spend this quarter than really any other quarter, really spending a lot on growth. And you can still see, though, Q3 always tends to be below the average line, as it's just an overall more efficient, more effective marketing quarter. So you can see the result there. It was less than that. Not as optimistic, though, not as good, as I had done some math and thought maybe customer acquisition cost might be $155. But based on it being, somewhere between 76% less than sort of the average would have been for these other three dots. But you can see where we came in at more like 175, we're actually more like 89%. So just not gives us another data point of where the sort of marketing efficiency is coming in at. And just for comparison, customer acquisition cost over time, you can see we're right within the sort of average ranges. We've had quarters that are 168, 191, and other ones that are as cheap as $80 per customer, just because they were spending less overall ad spend on customers. This graph right here shows total operating expenses versus IFP. Really tells a tale of their operating leverage as IFP continues to grow at a nice steady pace here, and we might even see again an inflection point as we head to higher growth rates in the next couple of years, and then operating expenses are staying quite level. The only uptick you see here is just because they're spending more on marketing. Otherwise, you go back to that graph that we saw in the report, and it shows that excluding growth spend, it was completely flat, but with it, there's a little bit of uptick there. Next, we have a couple graphs around how effective they are as a whole organization. In terms of employee efficiency, overall average of that. So we have customers per employee. This used to be higher when they were really only this was back in 2019 of Q4. They really were only like a renter's company only. So they had much less sort of complications in managing, administrating all of their policies, 1,900 plus customers per employee. But we're climbing back, and then they got more complicated, and now as they've figured out each of their policy lines, becoming more efficient, you've seen the employees per customer continues to rise, and I'm sure that will surpass the 1954 and go quite a bit higher as they sort of fulfill this autonomous organization vision that Shai has for their company. So, and then IFP per employee, this was again was lower because IFP per employee was not as good maybe back then, because so many of those customers were just renters and had very low premium policies. But that's continued to climb, and it should continue to just climb as they become more and more efficient and effective and automated. And if we look at what the stock is doing, we can see after hours it shot up from 1875 close to 2021 range, somewhere in there. So we'll see how it opens in the morning. But it's interesting. For me, it's exciting times for Lemonade because I think they're reaching this inflection point where car is going to become a major part of their book of business, and car, customers are suddenly going to be bringing in maybe $1,700 in premium per customer. at a loss ratio right now that's affecting the the overall loss ratio, but the current weighting is only 92%, and maybe this is probably going to go down into 80s and 70s, and then you have really a leverage point where an existing customer base can become much more profitable just through car ownership. So it's an exciting time for me. I think it's a great quarter. I think the market thinks it's a great quarter. We'll see how this plays out in the next few days and weeks and months, but I think it's a very exciting time for me. And also the investor day coming up, we probably will see more overall guidance about next year from that, or at least hints at it. Maybe it's not going to be as super explicit as an earnings letter. And then Q4, of course, we'll see guidance for the whole next year, which should be really interesting if that guidance is pointing towards higher acceleration in growth, and if their guidance is showing, hey, adjusted EBITDA continues to drop. So exciting times. Let me know what you think of this quarter down below in the comments. Thank you so much for watching. Remember, it's in the bag.